Smooth 981 to catch us live inside of the studio. You can also send us your WhatsApp messages to 0809 4440981. Again, 0809 4440981. Listeners, you can also send your questions via email to callme@stanbicibtc.com. That's callme@stanbicibtc.com. My guest today is Wonola Akombi, Head of Financial Institutions Sales Global Markets. And we're going to be the topic today is just pretty much understanding fixed income and money markets today with Stanbic IBTC. So Wonola, let's get started, shall we? We are in the final month of the year, of course, December. How would you describe the fixed income space and money markets in Nigeria in this year around this 2021 that we find ourselves?
Yeah, we started the year, at single-digit rates, and we started to see rates trend as government borrowing started to increase. So if you look at the bonds, for instance, they peaked at around 14.1% on the 2050s. That's a 30-year bond, while the 10-year bonds as well peaked around just over 12%. Right, and then obviously on the one year as well, we saw T-bill yields, rise as high as 7.5. But towards July, August, we start to see a bit of moderation in the rates. The 20-year bonds or the 30-year bonds basically moderated lower to around 13.8%. While the 10-year bonds moderated to around 11.8%, and then we start to see a decline in T-bill yields as well. Currently, 30-year bonds are around 13.3%, and 10-year bonds as well are around 12%. And obviously, we just had a T-bill auction yesterday, and yields around there is around 5.34%. So yeah, we've basically seen mixed reactions as government continued to borrow. We saw yields peak, and now that we've seen a calendar for the remainder of the year, yields have started to basically moderate. The largest players continue to remain the asset managers and pension funds. We're basically seeing offshore investors out of the market, and that's largely because of, again, positive supply of securities, the FX issues we're having in the country, and the structural issues we're also having. So it's been largely dominated by local players.
Well, okay, great. So sorry, I lost you there for a second because our network is a bit bad. Are you back?
Oh, you didn't quite get me.
Yes.
I'm here. Can you hear me?
Yes, loud and clear now.
So did you get, or should I take that again?
Yes, please.
Oh, okay. Okay, I don't know where to start from. I'll just start from the topic again. So like I said, we started from single-digit rates. Rates basically moved very wide in mid-year as government borrowing started to increase, right? We peaked around 14.1% on the 30-year bonds, while the 10-year bonds peaked just over 12%. And the treasury bills got to as high as 8%. Now we start to see a bit of moderation, and currently on the 30-year bonds, we are at 13.4%, and the 10-year bonds are at 12, while the one-year bills are around 5.34%. The largest players remain the pension funds, asset managers, driving the market. Offshore investors have been largely absent, and that's due to positive supply in the OMO bills, and also the FX structural issues we are having. So we're seeing multiple rates under the FX, and it's not really viable for investors. And a lot of them also have backlog of FX demand that they're trying to basically get out. So that's why we've seen this year's interest rate market largely dominated by local players.
So based on your description, would you say that fixed income and money markets have been a viable investment option in 2021?
Well, it depends on what you're comparing, right? So if you look at inflation, basically, inflation peaked at 18.2% in February, and since then it's moderated to around 15.99. And if you look at where yields are, they are basically lower. So you're seeing negative real return on investment. But again, these are risk-free rates, right? And for pension funds and asset managers, for instance, they're looking for safety first. So basically, they would prefer to still buy government securities because they are next to risk-free rates in the country. But if you're also comparing it from where we're coming last year in terms of yields are way better this year than last year.
So what about the foreign exchange market? What kind of year has it had so far?
All right, on the FX, I mean, it's really been around what CBN has been doing. So currently, and I mean, we saw our FX reserves, from the lows of 31 billion peaked as high as 42 billion. And that's largely due to inflows from SDRs from IMF, which was about $3 billion. And we also saw Eurobond sales as well, about $4 billion. So that basically drove reserve levels to 42 billion. However, we still continue to have those structural issues in the FX market. For foreign investors, for instance, they still have a backlog. We estimate that is over $1 billion. A lot of them have been, trying to see if CBN can increase supply there. However, it's clear that CBN's body language has been basically intervention around FDI sector. So if you look at the outside the I&E market, where banks and foreign investors trade, CBN has basically intervened about $9.8 billion there. So for importers, for instance, they've sold about $5.7 billion to them. For interventions into PTA, school fees, and SMEs, they've sold about $3.75 billion to that segment. And for the guys importing from China as well, they've received about $400 million there. Now in the I&E window, CBN has also intervened just over $3 billion, about 1.5 to offshore investors, and another 2.3 to corporates for dividends and loan repayment. In terms of rates generally, we've seen some deval. CBN has basically moved rates, and we've also seen them clamp down on the parallel market. Earlier in the year or mid-year, basically we saw them, stop sales to BDCs. We also saw them clamp on parallel market sites. And on the parallel market side as well, we saw rates peak at about 585, but that has since moderated to 535. And that's largely because of the interventions from the CBN into the I&E market and also to segments like PTA and school fees, who were putting pressure on the parallel market. So in the I&E, in terms of rates, where CBN is intervening, they're intervening at 440 and 450 levels, that's where they basically sell forward. However, NAFEX basically remains capped around 415 levels.
Great stuff. Can you walk us through yesterday's Treasury bill auction?
Yeah, sure. Yesterday, the government basically offered Treasury bills. I mean, they offered about 4.93 billion in the 91-day, 10.94 billion in 182-day, and 30 billion in the 364-day. But they ended up selling about 1.5 in the 91 days, 789 million on the 182 days, and 51.3 billion on the 364 days. And rates basically closed at around 2.5% for 91 days, 3.45% for 182 days, and 5.34% for 364 days. Now, obviously, the T-bill continues to remain driven by large interest from asset managers and, who run money market funds and some pension funds as well. The reason why yields have been this low there is because of the asset class. There isn't a lot of supply in this segment of asset class. So take, for instance, if you look at the total subscription yesterday, it was about 243 billion, right? Against about 53.72 billion that was sold. So the subscription was about 450 times oversubscribed, or the auction was 450 times oversubscribed by this segment. And that's why you see that rates would basically continue to remain low in that part of the curve.
Nice. Now, a question on, a question that has been on a number of people's minds have been asking is, one of the things that they've been asking about is, why does the rate on the 364-day bill continue to fall? What do you think is the reason for that?
Yes, so like I said again, it's the supply in that asset class, right? So so if you look at what happened in 2019, investors could, pension funds and asset managers could basically buy what we call open market operation bills issued by the central bank. Now there was a bifurcation whereby those asset segment or investors were basically stopped from buying automobiles, and then what they could just buy is the NTBs. Now, outside the NTBs, the only people you see maybe supply is maybe from corporates who issue commercial papers and banks who take deposits. Again, for asset managers, it's really more around safety, than more looking for aggressive funds. So this is basically the only asset class they're able to buy, and because of the supply there, they're just left to continue to pick up this. Now, the only reason this would change is if CBN starts to increase supply on the OMOs. Now, if CBN increase supply on the OMOs, then maybe banks can offer structures, whereby and take deposits at higher rates, because they can also make use of those funds. But if that doesn't change, we'll continue to see this decline in the NTB space.
So with inflation at 15.99%, and also the 364-day bill at 5.34%, would anyone be encouraged to invest at all?
They are investing. I mean, looking from yesterday, right? Like I said, over 243 billion was what we saw in the subscription. Again, it's not really about inflation. It's fine. You can argue that it's negative real return, but the question then is, what is the asset class they can put money in? These are risk-free rates in Nigerian segments, and again, like I said, the safety first. So that's why you continue to see investors buy this asset class, even though inflation is way wider.
So, how can just potential investors interested in fixed income or the money market get access to, to those securities that we're talking about?
Yeah, I mean, there are two ways. They can either buy from the secondary market. Stanbic basically do offer this to investors, retail corporates, offshore pension funds, asset managers. We do offer rates in the secondary market. And also, you could buy them at the primary market issuances. Again, but however, for the minimum size in the PMA, you probably need to do about 50.1 million, right? But for the secondary market, you can do much smaller sizes. I think that's 100,000. So any investor can always walk into either Stanbic IBTC's branch or send us like mails, and definitely we would definitely respond.
Thank you so much for coming on board, Awunuola. I appreciate you for coming through. We're pretty much out of time, but thank you so much for coming on. And that brings us to the very end of Business Express, brought to you by Stanbic IBTC. My guest has been Awunuola Akombi. He is the head financial institutions sales global markets, and has been joining us today to talk pretty much just helping us understand fixed income and money markets with Stanbic IBTC. Awunuola, thank you again for coming.
Thanks.